Okay, well, we're meeting today in the drop-in review session for financial accounting. And what we're looking at is the Chapter 8 problem. This is the second part of the problem. So we have already done the first part that relates to using the allowance method for recording uncollectible accounts. And now we're looking at the second part, which is completely separate from the first part. And this is about notes receivable. So we know that notes receivable are similar to accounts receivable in that basically we've lent money to somebody or we've allowed them to extend a payment period. So mostly what we have talked about was someone who had an accounts receivable with us and then needed an extended period of time to pay, and we agreed to that as long as they then pay interest. And so in this example, it tells us that in the trial balance for March, you can see a negative balance in the notes receivable for Fast Feet Company, which would seem to indicate that Fast Feet paid too much. But as we look back at what's happened before, earlier in March, on March 19th, we had an intern who recorded the receipt in payment of the note receivable. But the note was actually for $5,500. The payment was for $5,665. So we can assume then that $165 represents the interest that was paid on the note. So the first things we have to determine, because we do not have this information, you can see the line there that says we can't find any more information about this. So we don't know what the term of the note was. We don't know what interest rate was being used. And so we're going to calculate those things first. So the note was made on November 19th. I'm just going to write on the screen here so we can. So the note was made or signed, the day it was issued was November 19th. And it was paid then on March 19th. So that's the term of the note, November 19th to March 19th. And so we need to figure out how many days that is. So we start with the 30 days that there are in November, but the first 19 days until the note was made are not going to be counted. We have 30 days minus 19 for November, then 31 for December, 31 for January. We're going to assume that this was not a leap year. I don't see where it tells us whether to assume that. And then through March. And so those are the days that we are looking at. We have 11 days in November plus 31 days in January and December and January, 28 in February, and then 19 in March. And so the term of the note, if we add all those things together, what would the term of the note be? And that's going to be your answer to number 1. And then the second question asks us to find the interest rate on the note. We know the face value of the note, we know the term now, and we know the total calculation of interest. And so I'm going to remind you of the formula that we learned in class last week for the simple interest calculation. And it is interest equals principal times rate times time. And we now know 3 of these 4 items. So plugging in what we know, we can solve for what we don't know. We know that the interest was $165. That's the amount that was paid on top of the face value of the note. We know that the principal was $5,500. It's the interest rate we do not know. And we know that the time period was 120 days out of the 360 days in a year. So in order to solve for the rate, we will need to divide the $165 by both of those. I'll do it one step at a time just to make it easier to see. Give me 1 second here so I can get this typed and then you can see it on the screen. Okay, so the first thing I'm doing is dividing each side by 5,500. And then I'm going to, and we're going to get a big long decimal there, but then I'm going to multiply each side by 360 over 120. 1 second here to plug this into my calculator. It's not such a big long decimal. Okay. And so the 165 divided by 5,500 is actually just 3%. And then we multiply each side by 360 over 120 to get rate by itself. And so what we find is that the rate is, whoops. Good so far? So it's actually, it has the percent sign there. So you're going to want to just put the 9. Yep, just put the 9. Good. Okay. So then let's look at what's next. Any questions? I know your mic's not working, but any questions on what we've done so far? Are we good? Okay. So that last calculation, the term of the note is something we had done in class several times, but finding the interest rate is a little bit kind of backward from what we would normally do, where we would know everything but the interest and solve for the interest. So now we look at number 3, where it asks us to journalize the entry needed to record information about the note receivable. And this is on December 31st. So we looked at a similar situation to this in class this week, where we, in chapter 8, so last week, I guess it was Monday of this week, where we, the note was made in one fiscal year and due the next fiscal year. And so at the end of the fiscal year, we accrued the interest that we had earned, even though we weren't going to collect that interest until the next fiscal year. And so here at the end of December, we're going to accrue the interest that we have earned. So how many days were there in that same fiscal year? So we're going to do kind of redo part of the calculation that we did up at the top of this problem. So we want to know how many days that were there in November, and that would be 11, 30 minus 19, and then 31 days more in December. So that's a total of 42 days that were in the first fiscal year from the time the note was made on November 19th through the end of December. And then we just use the simple interest formula. Now we know the interest rate, so we can do this. So the simple interest formula, I equals PRT. We know the principal is the face value of the note. We know the interest rate now is 9%. And we're looking for the interest for the first 42 days of the note. And it says round all amounts to the nearest dollar. Did you get a number for that? If so, that's the interest that you're going to record, and debit to the interest receivable. Our customer Fast Feed now owes us $58 extra in interest that we have earned. And then the credit side is the interest revenue that's going to show up on our income statement. So same concepts that we talked about in chapter 3 with adjusting entries at the end of the fiscal year. We want to make sure that everything on our financial statements, includes all of our revenues that we've earned. So we've earned these $58 in interest, even though it's not going to be paid until March. So now let's go on to number 4. Journalize the entry needed to record collection of the note at maturity. So we already know how much cash was received in total. That's given to us right here. So where I just put the red box is the total amount of cash that we received. Yep. We also know how much the note itself was, the face value of the note. And so that, hang on one second. So that note receivable was set up back when the note was made, and now they're paying it off. So we want to remove that note receivable. Yep. So we want to remove that note receivable. Now back here, whoops, you scrolled on me. Sorry. So back here on December 31st, we set up this interest receivable, but again, our customer just paid us. And so the customer, Fast Feet, no longer owes us that amount. So we want to get that interest receivable off our books as well. Okay. And then the last piece is how much more interest we have earned. And there's an easy way and a hard way to find this out, because we already know the total interest is $165 and $58 of it was from last year. So the easy way is just to say, well, the total interest is $165 and we already recorded $58 of it. So how much is left? And that's going to be the credit to interest revenue. The hard way would be to take this same formula that we used here in the middle of the screen and do the remaining however many days. So there were 120 days total. So to do the remaining 78 days of interest. And that is a revenue. So that's going to be a credit. There's another way that you would know that it couldn't be a debit, because if you add up the debits and credits, they have to be equal in total. And so really the number we're looking for here is the number we need to make that equation, that transaction balanced. Okay, so we finished up the notes receivable part, and the last piece that I didn't realize was down here at the bottom. I thought we were seeing everything that was there. So the last piece, the final questions, says Fantastic Sports Gear Incorporated recorded $3,100,000 of sales last year and projects sales to increase by $360,000 in the current year. Last year, 80% of the sales were on account with over 400 customer accounts, and bad debt expense was $26,187. Assume that the Fantastic Sports Gear Incorporated used the allowance method last year, and we know that's required under GAAP. So if it's a publicly traded company, they have to use an allowance method if they have any significant receivables, and other companies can choose to use an allowance method if they wish. And the allowance account at the end of the year had a debit balance of $2,190. So I'm going to set up just so we can see it. I'm going to put here on the screen a T account for that allowance. I'm going to abbreviate Just going to call it the allowance for UA, uncollectible accounts. And it tells us that the balance in that account at the, excuse me, at the end of the year was $2,190. So that was our actually, I'm going to erase that. So that was our ending. Oh yeah, the end of last year. Okay, sorry. There we go. Okay, so we have a balance of $2,190 in that account at the end of the year before they do the adjusting entry. The company estimated uncollectible accounts expense using the percent of credit sales method, and they expected 0.75% of their credit sales to be uncollectible. So let's see what there we go. So their sales for last year were $3,100,000. And in the current year, they expected that to increase by $360,000. And they expect 80% of that to be on account. And so as we're looking at this year, their total sales would have been $3,460,000 when we take into account last year's sales plus the expected increase. And they expect 80% of that to be on credit. So that would be a moment while I finish writing this. Okay. So that would give us $2,768,000 in credit sales in the current year, if I just did my math correctly. Just going to check myself. Yes. Okay. And because they're using the percent of credit sales method, they expect 0.75% of that amount to be uncollectible. So if we take those credit sales and multiply by the 0.75%, so if you're using a decimal, if you're using a calculator with a percent sign, you can plug in 0.75%. But remember, if you're using if you're just going to enter the decimal, it needs to be 0.0075. You need to move the decimal. And so using the percent of net sales method or percent of credit sales method, we would need to do an adjusting entry to add $20,760 to the allowance account, and that's the same amount that we would record as expense. Okay, then the next question says, how much higher or lower would Fantastic Gear Sports Gear Incorporated's net income have been under the allowance method assumption previously shown in 1 than under the direct write-off method? So I'm just sure I'm reading this right. So we have here the amount that was recorded or would be recorded as bad debt expense in the current year. And we're comparing that to the amount we just calculated. And so the difference between those amounts is how much? Okay. So under the allowance method, we would have recorded $20,760 in expense. When we use a direct charge off method, we would have recorded $26,187 in expense. And so our income would have been higher under the allowance method than under the direct write-off method by $54.27. Okay, so I'm going to backtrack because I misread what they wanted. I got tripped up by whether they were talking about last year. When they say current year, they're talking about the year that's coming up, and they actually wanted us to be doing these calculations for last year, like the year that just ended is what they're talking about. So that is my misreading, and I just want to show you what the difference in the calculations would be quickly here. So rather than including this 360,000 increase from last year to this year, they really just wanted us to do last year's amounts. And I misunderstood that. So last year, the credit sales would have been 2.4 million. And so last year's so this amount would be the 18,600 that I have here in the red box. And then the difference between the bad debt expense direct charge off method and the new 18,600 is the 7587. So I apologize. I didn't recognize what they were doing. So when they said last year, if you think about when we're doing these adjusting entries, it happens at the very beginning of the next year. And that's what they meant by last year and the current year. So right now it's March, and companies that close their books in December for the end of their fiscal year, or even in January for the end of a fiscal year, are looking at doing adjustments from last year. And that's what they were asking for here, not the current year. And I thought that's what they meant. So there's our correct numbers with that understanding. And the reason I put the allowance account up here is I just wanted to remind you, show you that when we use the percent of net sales method, put a line here. When we use the percent of net sales method, we did not look at the balance in that allowance account at all in order to calculate the adjusting entry. And so our ending balance after we make that adjustment $16,410. That ending balance is found by taking the adjusting entry and seeing what change would happen, finding the new balance in the allowance. In this case, because it already had a debit balance of 2,000, that means we had $2,000 more in write-offs than we already had in that allowance account. Remember, the normal balance in the allowance is a credit balance, but as we saw in class, it can sometimes have a debit balance. And that's what happened here. They wrote off more than they had set aside in that allowance account. So when they set aside the amount for this year, part of that has already been used up because of write-offs that have already been recorded. And that leaves only $16,410 in that account to use through the next year.